If you want to know how you can have financial security during your retirement years, stay tuned to the Safety First Financial Show with founder John PENNACHIO.
So you've heard him before. We're so happy he comes on Saturday mornings, and he's our financial guru. That's what I call him, John PENNACHIO. And so many people are so concerned, about the stock market, about what they're going to do as they retire. Is their money going to be there for them? And so, John, this is what he does. He loves this. He loves to be with older people, retirees. So, welcome to our show today.
Good morning.
Good morning. There's so much to talk about, but let's just focus in on one little thing. What products do you like for retirees?
Well, I had made a decision several years ago that I was going to specialize in no risk products for people that are getting ready to retire or that are already retired. And they're insurance products. And I'll give you an example of just a couple. One type I focus on is annuities. Now, I will tell you that there are some good annuities, and I believe there's some bad annuities. And there's a difference. And in another show, we'll get through the differences. But the type of annuities that I like are two basic types. One is a plain fixed annuity. Think of it like a bank CD. Fixed annuity, if you go to the bank, you buy a 5-year CD, you might get 1.5% on a good fixed annuity 5-year rate. That means it's guaranteed for 5 rates. You can get 2.5 to 3.1% guaranteed each year. It's very simple. That is for people that just want a straight up, simple return without worrying about it. The other type of annuity I like is a specific type. It's called a fixed index annuity. It follows a specific index. It can be the S&P 500. It can be the Dow Jones. It can be the NASDAQ, several different type of indexes. And it credits generally depends on the type. It can credit once a year, once every 2 years. But if the index is up, you'll get a positive gain. If the index is down, then you will get a zero. And if you do the annual reset, that means that if the index was to drop 30%, you got a zero, your next starting point for the next year, you don't have to recover the 30%. It's from whatever the index went down to and the gain on that. Now, the difference between the good ones and the bad ones are the ones I don't like. The bad ones, sometimes they're the older ones. They have really bad caps. What a cap is let's say you chose an index that makes 12% this last 12 months. If it has a cap of 3%, you're only going to get a 3% credit. It's really bad. A lot of them that are out there now have fairly good caps, or they don't have caps. There's other ways of figuring it. So that's what I like. I like to be able to have a client to make a good return when the market's doing well and to lock it in and never lose your principal or your past gains. And when the market goes down, it's simply a zero.
But, John, so when people are in the stock market, this is different. This is an insurance product, isn't it?
This is an insurance product. It's totally different. You get measured by the gains of the index, but you're not in the index. You're not in the market. It's measuring the gains of that, and that's how you get credited. Now, there's one other part about it. There's a guaranteed income account, a lot of them. Now, an index annuity has no fees unless you add on this income account. There's a fee for that. You can say it's a type of insurance. And let me give you an example of what it means. Let's say that at some point you want to start taking income. And let's say that hypothetically the income of this product guarantees 6%. You have $100,000 in the account and you are drawing out $6,000 a year. Say we have one of these times when the market just stays stagnant and you've been drawing $6,000 a year out. Well, if you live long enough, you could draw that down to zero. And if you're in a mutual fund and you drew it down to zero, there is no more money to get out of that mutual fund. But on an index annuity with an income guarantee, if you drew it down to zero, it would continue to pay you that $6,000 a year to the day you die. So we're all concerned about income, outliving our money. When things are good, we'd like to get paid off for it. And when things are bad, we'd like to protect ourselves. So I truly believe that every person getting ready to retire, and I'll touch on that even more, or a person that is retired should have some part of their money with no risk, and not to go get 1% of the bank. To have a good, if you get a 5 or 6% guaranteed income, that's pretty good.
I agree. I mean, so why isn't this the most popular product?
It actually is very popular. Index annuity sales have been going up every single year, while variable annuity sales have been dropping every single year. So it is very popular, but you got to remember, people have short memories. So they forgot about 2007 when the market dropped so much, and they're thinking that, this is going to keep going on forever. And, people tend to sell low and buy high. And
they're not going to be if they're your client. I can tell you wouldn't let them do this.
Well, the most devastating thing I've seen is in 2007 when the market really dove down, crashed. I saw people that were getting ready to retire the next year or two that had to work another 7-8 years because their 401k dropped in half. They didn't get more conservative in how they allocated it. So have become the expert on certain type of guaranteed no risk products, very, very astute on annuities and what's good and how to use them. There's also certain type of life insurance products that we use that, which we'll touch on even more, but they're liquid. Some of them we use have no surrender charges. So if you were to put in $100,000, it's available if you need it. Same way the index annuities work, the market goes up, it goes up. But the death benefit has a living benefit rider, which means that if you become ill and maybe go in a nursing home or home care, it will give you about 96% of the death benefit while you're alive, depending on the product. And those things help protect you from ailments and things of that sort.
So is it that people who, let's say some people have their own financial planners and they're just not telling them about this? I think once you said that sometimes, unfortunately, there are people, supposed to be specialists, who are more concerned with commission than they are what's beneficial. Well, and I can say that. And I know that I'm not bad-mouthing people, but it's in every industry. And so that's the problem, right? That commission sometimes is more important than what's best for the person.
Well, it's all, it's a frame of mind. So a financial, a stockbroker, a money manager, okay, they are trained and they are motivated by managing money, trading stocks, selling mutual funds. And this isn't what I call really in their wheelhouse. It would be like a person that bakes pastries cooking you bacon and eggs. Okay, it's not in their wheelhouse. Therefore, they're going to usually say negative things about it. I'm going to give a statement that it's just how I feel. An annuity, you can't charge a fee to manage it, although I've seen some people do that. But you can't charge a fee to manage it. You can't buy it and sell it and trade it. So in some respect, I call it a new aside.
A new aside.
Which means that the broker is, if he sells an annuity a lot of times, unless it's a variable, his revenue stream stops. So a lot of brokers, it's not something that they like, nor do they recommend those products. And it's not necessarily because it's not good for the client. It just may not be good or it's not what these brokers have learned to use as one of their products. Now, some of them do, but most of them don't.
Okay, well, you have a lot of clients. So sometimes it isn't just, some people can have the fixed annuities and they can have other products too.
No, absolutely. The index annuity or a fixed annuity, it's all about suitability and it's all about liquidity. So would never put everybody's money in that. It's all about diversification. So where I come in is when we talk about the guarantees and protection, that's the portion, there's a lot to talk about in the first appointment to know what they need and things of that sort. So the bottom line is, no, we do not take all the business. A lot of times, and I don't mind competition either, but when someone does business with me, they have the person that I consider myself an expert on fixed, no risk. And do you really want your broker? This has happened to me in the past, and even though I tell a client, don't let this happen to you, it happened anyways. So I show them something that I think would fit them better on a portion of their portfolio. And they go back to their broker or their financial planner or their advisor and say, hey, this is what I've been shown. What do you think? Oh, I can do the same thing.
Yeah.
Well, why didn't, the client will even say, well, why didn't you show this to me in the past? Well, they end up doing it through that broker who, quite frankly, I hate to say this, a lot of them just don't have the knowledge on these products. A lot of times they'll go get the product just to make the sale, and it doesn't always turn out so good, because I'll tell you this again, not all of these products are what I consider great. A lot of them have great limitations on what you can make.
So it sounds to me like you've made this into a specialty, and you have to go and talk to the companies where the annuities are being formed. I mean, so this is a real serious business for you.
There's a lot of different annuities out there, and you really have to know your stuff. And, I used to own a broker-dealer, okay? So I understand the securities business. We sold the broker-dealer about 14 years ago to AIG, and because I wanted to move in a different direction. We had 100 stockbrokers working for me, and we housed them all. They were in about 4 different states. So it's not like I didn't know the other side of the business. I just continually to see that it's so dangerous if someone doesn't protect certain. I just give an example. You can do everything right. You can tax plan so you're paying the least amount of tax legally. You can hit everything right in the market. But what if your husband goes in a nursing home at 80, 90, 100,000 a year for 10 years?
You better have a lot of money.
You got to have a lot of money. And what if he had a pension that goes away at death? So wipes out your wife. The pension goes away at the death, a smaller Social Security check, where they were used to living on 50, 60,000 a year, and now she's got to live on 20, and the money's gone at his death. A lot of brokers don't pay attention to that aspect, and I'm not saying all of them do, so don't get me wrong.
I understand.
So we really focus on protection.
So we've talked about people calling you, and I want to now take that time to get everyone to give them your number again. It's called Safety First Financial. You're listening to the founder and president, and it is John PENNACHIO. And this is the number to call. Get your pencils out, 954-564-0052, extension 1. Again, 954-564-0052. Don't be afraid to just call and just sit down. You'll really like him. John's a very, very agreeable person. He is not intimidating. He's very experienced, and just sit down with him and see what he suggests to you. I mean, you can bring in your family with you, whatever you want to do, because he's very proud of what he does. When you talk with him, you'll see he feels so good when he's able to give somebody the right advice. And just like you said, that particular instance would not have happened if this were your client. What you talked about, right? You would have seen that, and you would have said, you can't do this.
Yeah, one of the questions, or some of the questions I ask a client when they come in is, what would you do if your portfolio lost 40% in the next 12 months? What would you do if if your spouse went into a long-term care situation at $100,000 a year? Or are you prepared for the possibly loss of income if you lose your spouse? So I ask those questions, and I actually, I want an answer from that to see if they have put things in place for these situations, because, I've come across people who've come to my seminars that I'll give one example. This wonderful lady, they really had a great retirement set up. The husband had a $40,000 a year pension. She was receiving approximately $20,000 a year in Social Security, and he was getting about $23,000. So realize they were making over $80,000 a year, and they had about $300,000 to $400,000 put away. They had a nice house, but they didn't need that $300,000 to $400,000. They had a little bit. They had about $20,000 a year coming in above what they were spending, and they'd give some of it sometimes to the kids and stuff like that. But he went in for 4 years in a nursing home, and her income dropped to $23,000 from $80,000. She doesn't have enough to live, and now she's selling the house that they've had for a long time, and it's really devastating. And there was things they could have done, and I'm not talking about just buying long-term care insurance. There's other things you can do to plan and protect yourself. That makes a lot of sense, so that, there would have been money at his death to take care of some of the lost income, to make sure that she doesn't have to change her whole lifestyle, sell a house that they've been in her whole life, and buy a little condo or something.
Okay, well, let
me
stop you there. So let's say that this was a client of yours. Tell me what you would have done.
Let me give you an example. First of all, if he's somewhat healthy, and somewhat healthy means maybe a high blood pressure but under control, blood pressure medicine, maybe even diabetic but under control. And let's say they had $100,000 sitting in a money market account because they don't know what to do right now. There's a couple of companies out there, more than a couple, have a type of insurance where you can put the $100,000, and I won't name the companies, but a couple, and put $100,000 in this life insurance policy. The death benefit, for instance, depending on the age, would be $200,000. Okay, the $100,000 is liquid, so if they need the money, they can go get it. Totally liquid, no surrender charges, nothing. And if they end up needing home care or nursing home, it could pay $200,000, $300,000, $400,000, depending on the type of product. It will multiply what you put in to cover that.
Wow.
And if you never use it and never end up in the nursing home, it's going to pay a tax-free death benefit quite a bit greater than what you put in.
Amazing.
So those are type ways you can protect. There's other ways you can protect yourself with annuities, which is a whole other discussion. So we'd have to do that another week. But yeah, there are things. Now people say, all you do is insurance products? Is that all you do? I go, yes. I'm special. I specialize in it. I mean, that's kind of like a doctor. There's doctors that specialize in certain things. And I get concerned when I see someone that just is the expert on everything, because generally they're not. There is a place you should have money in the market. And depending on your age is depending on how much you should have. Okay. But everybody that's retired should own, I'm just telling you, should own some of what I have. Because everybody that's retired should have something that guarantees no matter how long they live, they'll never outlive their money.
So I like what you're saying. So someone, let's say, would have Social Security, one or two, depending on the husband. And then if they had an indexed and a fixed index annuity, bring a certain amount of money, and then you took something that was an insurance policy that could also be used for long-term care, that would really protect them.
It would give them a lot of protection in a lot of different areas, and even that, depending on the life insurance policy, in some cases you can even take income off of that. So why it's still protecting you from long-term care, home health care, and that death benefit. Think of this: who you put it on whoever has maybe an income that's going to go away, knowing that if you each have a Social Security check, the smaller one's going away at death. That life insurance death benefit, if you don't need to use it for long-term care, will help offset the loss in income at death.
Absolutely. So what you're really doing is when you're talking to someone, I think you're absolutely building a whole scenario. What if? And they may not like all those what ifs. So you say, okay, well, if we did this, then what if, right?
Right, exactly.
So do you have this like on computer that
there's a software package we use that we plug in their assets, we plug in their income, their expenses, and based upon certain scenarios, it tells us how long their money survives and if they'll run out of income. And we can put a death in there on one of them because the Social Security check will stop or this or that. And it helps us show them where the flaws are. And so there's a number that it comes up with, and that number is basically what percentage of your income is guaranteed no matter what happens.
So if someone has $25,000 or they have $50,000 or they have, let's say $100,000, there's something that you can do which will just give them a little bit more security.
Once again, it all comes down to what's suitable. So you have to, but absolutely. And somebody has told me before, I only have $100,000. It's not really worth your time. And the reason why they say that is because they've heard so much from a lot of the financial planners that they only work with people over $500,000. Well, if that $100,000 is important to you, I'll sit down and talk to you. It's believe it or not, people that are worth $3-4 million, the 100,000 is a lot more important to the person only worth 100,000. So
yeah, absolutely. So in other words, if you have someone with 100,000 and they like what you're telling them, they probably have more than 100. You then maybe put 200,000 in, which would even be better.
Well, it all depends how much money they have, how much they need liquid, what's suitable. But the bottom line is, I've sat down with people worth $200,000-$300,000, and there were so many holes in what they were doing, to be honest with you. 2 weeks ago, I sat down with a gentleman that was 92 years old. His wife was only 80. Okay. And he had 80% of his money in individual stocks. And they did live off of the investments.
Okay.
Now, he's 92, but she easily could live another 15 years. And to me, that was pretty risky for a 92-year-old person to have 80% of his money in individual stocks. But, he just believes that he was the stock guru, and he had no stockbroker.
He did this himself?
All himself, picking out the stocks himself. Well,
oh, my God.
He said, look what I've done in the last 6-7 years. And I didn't want to tell him everybody's done well in the last 6-7 years,
Right.
The market has done very well since 2009.
So did he listen to you?
Well, a 92-year-old, the only thing I would ever suggest in any type of investment with me would be just a fixed annuity, just like a bank CD. And that, to him, that wasn't aggressive enough.
But you'd be protecting his wife.
Exactly. So the answer to that, to your question is, he's forgotten about 2007. So he's staying the course. And it could be very dramatic if the market drops pretty significantly because they need the income from his investments. And these are the type of things we see. I'm really concerned about the next bear market because a lot of people are going to be hurt by it.
So I know we weren't going to talk about it this time, but you did just briefly say something about variable annuity. We have to be very careful when people are listening to this that all annuities are not the same, and maybe you better specify that again.
Variable annuity is an annuity that's invested in the stock market. They're invested in mutual funds, but they're called sub-accounts. That's what they're called. And generally, they have high fees. I've seen variable annuities with the riders, the M&E, which is the mortality expense, the fund fee. I've seen them as high as 4.2, 4.3%, generally in the mid-threes. And I will tell you, when they force a person that's retired, they force the agent, the broker, to allocate the funds a certain way. A lot of times it's 50, 60% of that variable annuity has to be in bonds, usually bond funds. When your bond funds are earning 3.5% to 4.5%, and you're paying that in fees, it's really hard to make money.
And why is that allowed? I know that sounds crazy, but why would that even be allowed? Well,
number one, it's the company does that to remove some of the risk to them, the insurance company. Number two, when you do asset allocation for somebody retired, the old asset allocation models kind of force you into that. Forces you. Bond funds are considered the safety part of the income part, and it would be perfectly fine if you're making 3.5%, 4.5% if there wasn't any fees.
So let's say someone comes to you and they have a variable annuity and they want to get out of it. Can you help them get out of it?
Yeah, let's say someone has a non-qualified, that means a non-IRA variable annuity, or any type of annuity that no longer fits. Kiplinger's came out with an article that says, trade in your old annuity for a new one if it makes sense, and you could do it through what they call a 1035 exchange. That's a tax-free exchange. Got to make sure there's not high surrender charges. There's a lot of things we have to make sure, okay? And if it's an IRA, we can do a rollover. Once again, there's things we got to look at. Does the variable annuity have a specific death benefit that's higher than the account value? Things, how much is the surrender charge? Are things we got to look at. But if it makes sense, you can move one of the, I call it an annuity. As I said, there's a lot of bad annuities out there. And if you have an annuity that is non-qualified, non-IRA, that's grown, you can't just sell it. Because what happens if you sell it? You pay income tax on all the gain. So there's ways of dealing with that, and a lot of people make the wrong move. They get out of an annuity without knowing the ramifications of doing it.
Something else has happened I read about, and probably it's too long a discussion now, but some people who have insurance policies are asked now to add more money. to the insurance policy because something is not worth. What was that story?
They bought either variable universal life or they bought universal life, and the proposal or the illustration were based on a high rate. Even fixed universal lives back 15 years ago when the interest rate was 7-8%, today they're 3%. So the interest helped carry the premium. And as the interest rate dropped, it didn't carry the premium. And now these people have to either start paying premium again if they originally did a lump sum, or they got to start paying a higher premium. And it's a bad time to find out about this when you're no longer insurable, or you bought it at age 60 and now you're 75. Because it's a tough decision if you're spending $4,000 a year on the policy and now you got to spend $8,000 and you really don't want to get rid of it because you're 75. It's funny you said that because I have a gentleman that asked me to come out to the house. I did yesterday because his wife had a variable life. She has had it for 22 years and it just ran out of money. It had been paying itself. And now the premium is going to be $9,000 a year.
Oh, please. This is very frightening. Well, maybe we'll cover that another time. But, John, it's wonderful. I love having you come on the show and start to break down a lot of these things that people have been worried about. So please be sure to call Doctor. That's right, Dr. John Pennacchio. That's what I think about you. John Pennacchio. Call him at 954-564-0052, extension 1. And be sure to read the Boomer Times, and he has his article in there. The one coming up in September is How Much Do You Know About Index Securities? And then be sure to go to the seminars that he has. So I think what we can do is make sure that people see. Let me talk about your website is let's see, I see it as SFFCO. Right? .com. No, it's .consulting.net.
No, it's sffinancial.net.
Oh.
There's two different. There's two different
what
ones.
should we use?
sffinancial.net.
Okay, sffinancial.net. And if they go on to your website, right? If they go on there, they'll be able to see any of the seminars that you'll be having.
Right.
Okay, that's good. Okay, but it's easier. Call him at 954-564-0052. Tell him some of the situations that you're in, and I bet he'll have an answer that you'll like. Thanks, John.
Thank you. Bye-bye.
Be sure to listen each Saturday morning from 7:30 to 8 on WSBR and hear John Pennacchio, founder of Safety First Financial, talk about important retirement strategies. Call 954-564-0052 or go to their website, sfinancial.net.